Hello, everyone. Happy New Year, New Year's Eve to everybody. I'm not sure if it's the new year anywhere in the world yet, but not on the East Coast of the United States, anyways. Great day here in Florida. I'm looking forward to the early closings today so we can get on with the fun today and tonight, the hockey and the champagne. So it's been a good week, busy week. I'm glad to see a few people here today. We're going to miss Richard, I think. He is not going to make it. So it's been a long time since I've done one of these without Richard to back me up. And I'm going to be very careful because he can always correct me, as some of the rest of you guys do as well, when I mess up. But so I'm going to have to be more careful today. But I'm sure he'll be listening and give us his comments next week. So I'll start inviting people up. I will start off by, I guess I put out there as the topic, one of the topics to discuss today would be last week's podcast with the big group. And it was, I guess, 3 hours long. I think Niels is going to break it up. I was hoping to entice some of the participants to attend today's Clubhouse, but no one so far. I mean, we don't need them because I can tell you what we said, what we should have said, where they were all wrong, etc. You know how that is. So, but it was kind of fun. And but we never got the face-off between Rob and I on volatility targeting, which is we've just talked about so many times that was probably unnecessary. So if you have any questions about that or comments, clarifications about that, that's a good place to start. Mike's on. Oh yeah, so Mike, he's my good friend. He and I play fantasy hockey together, and so I'm sure he has something to say.
How did everyone weather the last spate of drawdowns mentally?
What drawdown? Near the highs.
I guess it depends on your markets, but yeah.
Well, that's something I know. Yeah, Jerry and I were talking about. I believe it was maybe a month ago. I forget when the exact day when Jerry was in the city. We got together and we were talking like, oh yeah, you click through the charts and you see drawdowns everywhere, except in our P&L. Like a lot of the base metals, um, some of the grains, and then even most recently energies. Um, just sticking commodities specifically, and I don't know, just not really flowing through to the P&L of the fund itself. So it's just a great. It's just been just an incredible environment to where and a good lesson in diversification, and that you can have drawdowns everywhere in individual markets, but they like seem to be taking their turns, and they're not so highly correlated to where we're all getting hammered at once.
Not all
Um,
at once, yeah.
yeah, I mean, I think maybe we had some currencies kind of pick up that just like out of nowhere, Israeli shekel and Turkish lira. Trying to think of some other thing. Oh, and then you have carbon emissions still rocking, and then cotton, and some of those smaller commodities that you just sometimes forget about. Now I trade around 100. Jerry trades more. 150, 200, and sometimes you just forget about so many different things you have that are just picking up the slack. Yeah, that's something I've been noticing over the past, especially over the past few months. It's like, okay, at some point we're gonna start losing some money, and then you start clicking through the charts. You see these huge drawdowns in these individual markets, and you're just like, what the heck? How come we're not losing money? It's a good thing.
I have a question. can you do a trend following probably long only and not a long shot?
Yeah, you can.
I mean,
Um,
does it work, or rather, let me put it differently, does it work if you do it long only and long
Work
shot?
in the sense, does it make money?
Yes,
Um,
absolutely.
well, it'll work differently. Let's say that than a a rule, a trend following system that only takes long trades versus one that takes longs and shorts. Have a different return profile. Um, I think, in my experience, a lot of my testing, it shows that it does work, and it does make money. Um, doesn't perform as well in, you know, obviously downtrending markets where you're sitting out instead of being short. Um, and we've had you know, some good periods where there's been good shorts. Um, so it's not something to, I don't think, it's not something that you might want to not do. You always want to, I think, ride downtrends as well. But if you're hell bent on just going long for whatever reason, um, you can only trade stocks. You don't want to borrow money, and you don't want to trade futures. Maybe it's too complicated, or out of your comfort zone, wheelhouse, whatever. Um, then you could give a crack at the long only side. But yes, I mean, a lot of my testing, I've seen, yeah, they do make money, they do work, um, but just be careful that you're prone to a period where things don't go up very well, uh, or for very long. If you run into a period of stagnation, if you're trading only stocks, for example, I've seen many periods like that in many different stock markets. U.S., Asia, and Europe, um, among other places that have just had a lot of stagnation, don't go anywhere for many years, and um, in those periods, it might, having the short element could help, but obviously we don't know what the future holds and what periods we're going to go to. But I think it's a little bit of a weaker overall long-term, 10,000-year strategy, just to be one, just to rely on one side, the long side.
Yeah, and Gurov, I would recommend, if you can, picking up Andreas Kleinau's book, Following the Trend, and our vol targeting buddy, Rob Carver's Systematic Trading. And that'll help you with your back test so you can see if you're set on a long only approach, how that might play out for your given market segment and risk parameters and budget.
Yeah, absolutely. Thank you.
I think looking at the back test and the trade statistics, it's very tempting to limit the shorts, or and I know this probably wasn't on point with your question, but just in my experience, I have tried to figure out ways to do less shorts in a systematic way, and then I think I've been less aggressive and then more aggressive, and when I was more aggressive, thinking that the shorts are not nearly as good as the longs, um, I really had periods where the shorts were really good, and I was really punished for that. And then I think to some degree, you're looking at the shorts sort of like mentioned before, like a short-term system that may not be nearly as good as the longer or medium-term systems, but it adds diversification. And I don't think it's profitable to get rid of the poorer trades, the shorts that are worse bets, so you could trade the bigger trades bigger. I don't think it works that way. I think it actually works the opposite way, where if you're taking these shorts and they're not as good, they will allow you to trade the whole portfolio a bit larger because of that diversification those shorts are giving you. And then even when I've had a lighter approach to systematically and I think kind of legitimately, uh, reducing the exposure to shorts, what has happened a couple of times, to me, I mean, it works like great. I mean, it's fantastic. But then all of a sudden, there were two periods that stand out: COVID and 2018 or something. I forgot the year now, but it was a period where the shorts were really good, and they they turned out not to be great trades in the long run, but they ended up being really helpful over a month or two period. And then I sat there with tremendous relative underperformance, and I was like, this is the worst thing ever. And it's kind of like worse to have tremendous underperformance relative to your peers. But then over the next few months, those trades were not that great, or they turned into losses. So I mean, I was correct, in that they're not really great trades, but they punished me over a short period of time, and it was kind of painful. So you have to sort of make up your mind to some degree, what's worse. So I think I've taken a more moderate approach to eliminating some shorts, but and then of course when you do your back test, you want to include the short trades to increase your sample size.
I think that I don't know. Do you hear me or not? I think it looks like I have some technical issue. But if you hear me, I want to say that it's very important to us to have long and short, as I know, according to transform philosophy. And I liked the words of Jerry from the previous episode that he said, I'm willing to accept short-term weaknesses. I think it is dangerous trying to go back into your systems and trying to fit some rules to eliminate volatile days in your very profitable trades. And I think it shows the importance. I remember one of the first things I learned about trading was someday all the longs will go down. So I need some shorts. So I think that we don't and as I remember Neil said that we go shorts. I don't remember his words exactly, but he said that we trade in a way that how we trade because we don't know the future will bring us. We don't know what will bring with a short, what will be in a short side in the future. So now, yes, we see now that 90% of profitable trades are long trades. But I agree with Nils. I like this idea that we don't know the structure of the market, of the future market. And maybe there are short, and we have examples where shorts get a good job. So, and I think it's not bad. It's a good idea to trade long, short, currencies, commodities, and so on and so forth. So it's a type of diversification, and I think we must trade shorts.
Yeah, that's a good point. That's a point I bring up a lot, where when I learned how to trade, it was definitely said that just having any kind of shorts on, because some days all the markets are down and some days are all up. So, and that's what happened during COVID, is that it wasn't just the stocks that got hit, it was all of our longs, and turning those longs off and shorts on uh, was, it was very important to do.
Yes,
And
but in all crises, it's I think it's a quality of crises that all go down. So we can show a good performance in crisis when we go short. And if we go short in another period of time, we will not have a very bad performance here, I think. Maybe our performance will be not so big as it could be without shorts. I agree with it. I accept this. But accepting this, it helps us to be more stabilized in a long run perspective and in a long term horizon, invest in horizon. And so I agree that we must trade shorts.
And Michael and Jerry may recall as well. I believe, and John Borman has subsequently passed away, but I believe he had a long only equity trend following fund, and I don't know how that ended up or how it's. I'm assuming it closed with his passing, but they may know how that performed, particularly during some of the more turbulent times.
I don't. I have no information on it or how it performed. But I can imagine, during a 10-year bull run, I'm sure it did pretty well.
And if we are talking about commodities, Neil said that maybe 70% of the time commodities prices go down. So there is not much sense to trade commodities without shorts.
Precisely, Oleg.
I remember having this discussion with Rich one time about stocks, and this was like probably the 90s or early 2000s, and how adamant I was about trading single stocks. And then I admitted that the research shows that single stocks shorts are not very good. And part of the reason I think is that well, there's a data issue you have to overcome as well to do the back test, and then it's usually because the volatility of the stocks as a percentage of their price is usually higher than a lot of the other markets. But anyways, as a good trend follower and researcher, you have to, be obsessed with this sample size and doing this back test and creating a system that produces thousands of trades in the back test. And you've got to include the shorts in there, or you want to include the shorts in there, and you want to trade them the same way as the longs. You want to trade all the markets the same way, and then thus you have this. This is how you capture this sample size, and you tell yourself all these markets are the same. There's no personalities. I mean, that it looks like cocoa doesn't trend and the yen trends and crude trends, but just don't think about that, and then don't think that the shorts are different than the longs. Wheat has worse performance, cocoa has worse performance in the back test than the yen and crude, but so what? And so what if the shorts are worse than the longs? And so this is hardcore, robust, classic trend following research. And so Rich's response, I mean, without like missing a beat to this idea that the stocks are great, but the shorts in the stocks are like worse. I mean, we couldn't really find a great way to make money in the shorts in stocks. His response was, well, I mean, you should expect one of these days the shorts to do really well. And I think, yeah, I mean, that's the response, And I think we live these dual lives where we believe this stuff about robust research and systematic, in the correct way to do systematic backtesting. But we live in the real world and we're just like shaking our heads like, no, I'm never going to see a period where the stock shorts are great. They're not ever going to start approaching the longs. But I'm not going to let that impact my back testing or my trading. And I think it's just kind of funny. And then, you can, I think it's doing all of that, you can still be very successful. And then the temptation is, well, I could have been more successful if I would have like done fewer shorts. So I doubt if that's true, but it is a conundrum.
Jerry, when you select your equities for your system, I'm assuming you perform the exact same
analysis as you would any other market um, for those equities, or do you do something different for equities that you don't do for, say, the futures? I'm assuming it's all universal and the same because that's what you've preached, but just clarifying.
Yeah, I mean, it's all the same. I, choose my systems just based on the trade stats, and I don't want to look at too many currencies or too many bond markets, or stocks. Stocks have trended well, and if you put in too many stocks in your back test, you may choose a system that's not great for all the markets, and then you may get an idea, an unrealistic idea of the profitability. If you include markets that have done better, or if you don't use enough data. So, but then I don't. I just choose the markets irrespective of the back test and how those markets did. I just choose the stocks based upon themes and diversification. But I remember I told a story about a few years ago when I did a back test and with some new stocks, and I forgot which stocks I included. It probably was Tesla and Moderna or some other crazy stocks. And my researchers were really upset because the back test was not very good for those stocks. And I was reminding them, like, that's not how we do things. We don't look at the back test to determine which stocks to trade. We just choose all the markets based upon their liquidity and diversification, and then we do the back test, and we assume that all the markets we ascribe those trade stats to each market. The expectation per trade is 2 ATRs for the group, and that's the expectation for corn and Swiss and yen, not their actual expectation on the back test. It's whatever the group is. That's how we get the sample size. So it seemed to work. But I would just to echo what Mike was saying earlier. I do think it is kind of a nice period we've had here. I don't remember it being this good before, where we did have some big trades and they kept going. We had some big trades and they draw down, and then something else would take over. Like he was saying, we had some massive drawdowns in some market. He's probably outperforming me, but um, that has been a nice feature um, where things have been correlated, but there has been some outstanding moves in like all the grains went up, but some of them went up a lot more than the others. And then we got on the right side of Turkey, at least for a while. So it is quite amazing to see um, all of these small little trades I have on. Some of them have made a lot of money, and I look at daily um, the the size of my position. So I size them initially based upon their volatility at the entry, and then I don't want to touch those trades. For I'm not going to scale them back, but I look at the real life size of the trade. So when I put the trade on, it was really small. I was going to risk 25 basis points with a healthy stop loss. So if it went, multiple ATRs against me, I would lose 25 basis points. And so that trade, pretty insignificant. But given the volatility today of some of those trades, some of those positions are pretty gigantic. So it is. I do trade small. I do risk small amounts of my capital, but that trade can really be crazy, and just dominate and ruin my day or make my day. So it is a funny way to trade, and just looking at so many markets, it is a
Um,
good distraction not to be focused in on anything too much.
I liked these words very much, fully agree. And I want to say that a lot of examples, really, in our real life trading, a lot of examples, for example, Turkish lira. And when I start trading Turkish lira, maybe 18 months ago. I started to trade it. It was I risked only 100 United States dollar. Now this this exposure near it's now profit near 4,000 USD. So it's very nice quality of trend following that we have not much risk. We cut our losses and we let our winners run, and it's great philosophy. In fact, when we see the practical side of this, it's for me personally, I understand how great it is.
Hi, Jerry. Can I ask you a question? Those gigantic trades, I guess, are part of your open equity, if they are still in your portfolio. Did you ever, and I know that you use the closed equity to size your future bets. Did you ever try to backtest the difference between using the open equity versus the closed equity, or you didn't even bother?
Oh no, I definitely back tested that. I don't think it matters most of the time. I think I saw an article the other day. I tweeted this, and I forgot where it was from, but it was definitely reputable. And maybe I don't think, and maybe it was AQR. I don't remember, but they basically said they didn't see any difference between trading every market in your portfolio the same size or doing some intense correlation analysis. And so that's exactly what I saw as well. If you look at enough data and enough markets, all the precision of trade level and all the precision of sizing the markets based upon the correlation and trying to change the sizing when the correlations change, it just gets, in my opinion, washed away. And so that's exactly what we came up with. A trade level, it usually is not going to matter so much um, how you do the trade level. I think one of the things that I definitely don't um, like at all is truing up the positions. Like just you put the trade on, on the date, and you use the trade level. You're using a rule. You're consistently applying the rule. Then you're really making some progress here. But on January the 1st or every month, I'm going to resize the trade based upon the current equity or the current volatility. Now it's like a non-system trade, and you could have had the trade on for a year or two, and now you're going to resize it, and it's made a ton of money. I think stuff like that, I think, is way worse than than the trade level calc. I don't think the trade level calc matters very much most of the time. I think you do probably open yourself up to putting on trades, especially when you're very profitable. Putting on trades with the current equity, at all-time equity highs. If you put on a lot of trades at that equity high, just the breakouts were happening and you put them on, then those trades are larger than the trades you've had on for a year, and you could lose money just because of that sizing, not because of your system. Um, or it could impact you negatively. So I have an edge in my system. I want to play that edge. I don't want the randomness of equity changes or trade level sizing to have too much of an impact.
Yeah, but I guess that's I don't know if it was, let's say, Coda, who said that there was difference or no difference between the market money and your closed money, and I guess it's a philosophical question. I guess you're right in that if you get too crowded in new trades at a very high level, you could have a huge drawdown. But then again, the compounded growth rate of your portfolio will be less, right?
That's right. I mean, you may have a issue there, and you can see that in the back test. So you can afford to trade a bit larger if you're not changing your trade level very often. So you can make it up that way, which I think is a little bit better. But I don't really understand Ed's quote. I mean, I don't really understand where he's going, because it seems to go against letting your profits run, you know. And so if all of this equity, the losses are the same as the big winners, we certainly don't treat them the same. And I definitely agree that on a daily basis, you can't pretend that you're not having this drawdown. You're marking to the market, and it's painful, and you have clients, and you don't want to give back all of your profit. So I get that. I wish we were more like private equity, where we could pretend what our equity is and not show the drawdowns. But I'm down with that. But I don't. I think the whole um, philosophy of trend following, letting your profits run and taking small losses. Well, there you go. It's right there. There's the difference. If it's a loss, I do something very different. So you're going to take 25 basis point loss. Yes. Well, you're not going to let your profits swing more than 25 basis points. Oh, I certainly am. 125 basis points, 325 basis points. I've done the back test. This medium to long breakout exit is wonderful. It's great. It makes tons of money. I don't get out of my profits until that stop loss gets hit. And sometimes it's going to be very large give back, and sometimes it won't be. But I absolutely treat my losses and profits differently, and and so I don't understand the point that that you can't be you can't take advantage of the freedom and the profits that trend following gives you if you're going to be taking small profits.
I remember Moritz said once that he doesn't know any he doesn't know any successful traders that do such thing, take small profits. So it's very, very, very against our transform philosophy. I don't know another strategies, but I think it's hard to imagine a strategy where your profit will be small and loss will be big. And so it may be only the strategy that will ruin your account, I'm sure.
Yeah, I think most of the problem here is what Jerry was talking about before. You get to a point where, a handful of positions, these big gains, drive your day-to-day P&L. And unless you're prepared to make a sort of difference between open equity and closed equity, in which case you let your open equity do whatever they want, then you this mark to market or open equity give back has to be addressed. So one way to do it is that resizing as markets move and dependency structures or correlations, as well as volatility or sort of underlying variance in your portfolio changes. So it really goes back to how you do your accounting, what your premise is, which world you live in, arithmetic returns, geometric returns, whether trades simply add up, and as Jerry says, you have to maximize the outcome of each trade, or you think in terms of portfolios. Doing a little bit of this, a little bit of that, definitely doesn't work and leads to what Jerry says, this bad rule of taking some profits every day. But I am of the opposite camp and think I'm always thinking and worried about the portfolio. So I have to think about not only open equity P&L, but also making sure that all positions size relative to the risk and opportunity set that each position gives me every day, or every time I manage or recalculate my risk. And it's not symmetric because volatility is not symmetric in my world, and things are time dependent, but not they don't risk structures don't vary every day. So I don't do what Jerry says every day, taking profits. But at some point, you have to confront even what Andreas was saying. How do you protect profits that haven't really been crystallized to equity but are large and are driving your portfolio or your or your return?
I was thinking that in terms of long-term expectancy, just playing the devil's advocate here, but if you have a system, which in this case is trend following, which has a a great long-term expectancy, uh, if you update your equity for doing the next trades, unless you have a big accident, it will be you will get the highest compounded return, right? And unless you have an accident.
In theory, yes, but you have to properly account for volatility drawdown. So in theory, what you're saying is right, but there's this friction coming from, um, what you call the accident, or deviation from your long-term drift, or your expected return, however you want to call it. So it's tricky. In theory, I can see why you're saying what you're saying, but the practice is completely different. So I don't do it to maximize my terminal wealth, because I don't know when my game ends, if you wish. But I do it because of the volatility drawdown. I don't want to get caught as much as I am when things turn out very bad. And Black Friday was a very painful experience, but I reckon it could have been worse if I didn't try to manage ahead of it as much as I could. Obviously not well enough, but I something happened before.
Yeah, I agree with all of that. I think we do live in this real world, and we have to take into consideration. This was something I tried to bring up in the big podcast, which is, we have these rules, but the rules it's not just a question of rules, it's a question of the robustness of the rules. So we don't want to have these rules that we implement frequently that don't have sample size behind them. And likewise, I'm okay implementing a rule with almost no sample size if it's infrequent. So rather than having to be a core component of my system, um, I'll just say, if I have this certain level of profit and the ATR has, quadrupled, then I'll take off some. It's not much of a rule, but it's just acknowledging that there's nothing behind it math-wise, and I'm just uncomfortable. I'm a human, and I think that's just fine. I'm not going to pretend to myself that doing this back test with all these rules that the computer will just totally find. It'll totally go out and grab the best rule on how to take a profit when the size of the profit is very material, and pretend to myself that that's going to put me in a good stead in the future. I think I'm not going to do that. Um, I think the problem with exits that are not of the one, the breakout exit or the moving average exit or the stop loss exit. The problem is that is that those breakout exits, they are robust, and they have the backing of thousands of trades, whereas some of the you got to figure out a way to get that same level of confidence and from the non-system trades, or I got in trouble for calling them non-system, but the non-core one entry, one exit, a stop loss, type of idea. Um, but I really didn't understand what Bruno was saying about something about size based on opportunity set. I think the way I look at it is the expectancy of the system rules is whatever the expectation of the system is. And it's not something I can think of on a daily basis. My average trade for my system may be 2 ATRs, but I don't know what that is after I've been in a particular trade for a year and it's made a lot of money. Um, you know, people used to confuse me by saying, you should look at this as, would you buy this today? What is the expectation today? Or would you do this trade today? And if you wouldn't, you should get out. And I was like, oh yeah, that does sound reasonable. But I think that more accurate for me is that the system told me to do the trade a year ago. And now I've got this big, huge profit. It's very volatile. It probably is towards the end of the trend. I mean, I don't really know. But in order to capture that positive expectancy at the level that my back test indicates, I have to exit based upon that breakout or that system exit. And it has nothing to do with whether I'd buy it today. That's not a relevant question. Or what is going on today? No, it means nothing. I'm here to implement my systematic approach and do those trades when I should, and I'll walk away possibly. That's my best chance of walking away with something that looks like the back test results, and I'll be very happy with that.
Yeah, what I meant by it is, if you remember, there's two axes, if you wish, in the way I think about, opportunity set. One is the strength of a signal, because I believe that, um, trades shouldn't be put on as a digital event, but should be, gradually scaled into a position. So, that sort of has a transfer function, if you remember the sort of vernacular they've been using. But, the fact that, unlike you, that puts on the trade in one lump, I sort of bit up to it. And the other one is how well this particular trade contributes to my portfolio diversification, which is slightly different from your concept of diversification. You're happy to be in 25 different grains. I track more than one grain, but then I also have to think about, if I traded these two grains contextually, how much I would gain in terms of diversification, and would that be enough for me to pay the price of trading costs and everything vis-a-vis the benefit of diversification. So that's why the opportunity set shifts a little bit every day. But I want to convey the point that you think that all we're doing is just getting crazy, calculating thousands of parameters and then reacting to the minimum of change in those parameters. I've often spoke about the concept of ballast or inertia factor. I mean, I don't trade a tiny change in the optimal portfolio versus my actual portfolio. Things have to have a material impact, and material impact it's when my theoretical portfolio deviates from my actual by an amount which I've described, and is function of what I want to achieve. So that's why I keep thinking in terms of opportunity set. As you said, it doesn't make any sense to you thinking about whether you like your position that you put on months or years ago today more than you did yesterday. And I agree with that. We don't do that. But how this position in my world, how this position sits relative to signal strength, as well as overall portfolio mix and combination. That's what I mean by the daily opportunity set, and that may or may not create a trade as a result of it, as a result of changes in daily changes in it.
Yeah, I definitely want to try to scale in. System 1 gets in, and then system 2, 3, and 4 they can all get in at the same time, but because the breakouts can be the same level, but I definitely attempt to scale. Derek came up with this idea a long time ago about, I can't remember exactly how he worded it, but he was given this a good explanation about how important it is to add to profits or to scale in. Um, and so I was like, oh yeah, I like to do that. It has to be sort of a natural. I've tried historically to force the scale to make sure that if the breakouts all hit on the same day, I would not take this trade on the same day. That doesn't work as well, because obviously you're introducing another element to where you're not being consistent for the sake of scaling in. But yeah, it's just as you said it. I have this diversified portfolio when I start, but after that, it may not be that diversified. And so I put it together without doing any trading, without even deciding the systems. And I'm very happy. I look at all these markets and I'm like, oh yeah, that's a lot of diversification. And then something comes along and it can go long periods of time where it's not diversified that much. And I'm not going to do anything about it because I'm this slave to consistency. I'm going to have this fixed portfolio. Then I can start applying these rules and do the same thing every single time, handling all the trades, all the longs and the shorts in every single market in the exact same way. And so and that is this replication of what I did in the back test that generated this large sample size with as few parameters as possible.
This idea of trading consistency, because I think it's one of the most important things in trading. and in every business, I think so, to be consistent. And I like words of Jerry that we must follow only good rules. And I think that if we are consistent even in a bad rules, we will it will lead to something. So if we are talking about discretionary processes, I don't understand where it can lead. But if we are consistent in something bad, for example, if we drink 5 liters of beer every day, it will lead to problems with health maybe in a few months. So yeah, and if we do something good for our health, it will lead to that our physical shape will improve. So go to sports, for example. And I think that we build a system with a consistent rules, bad system or good system, and of course we must go to the path of through the path of good systems. And so I want to say here that I liked very much the words of Jerry that we must follow only good rules and be consistent in it.
Then there's the issue of managing other people's money, right? Because the way that your clients enter into your equity curve will be different from one to another. And in that case, being a little more, being more aggressive will make a real dispersion of their results. If you, on the other hand, try to be more diligent with trying to manage your drawdowns or have less drawdowns rather to manage them, it will make the returns more equal, so to speak, to all your clients.
Yeah, that's definitely an issue for me where I discourage people from investing sometimes because there is, so much open profit, and I want them to have a good experience. So it's not going to be great in a long-term relationship you know, to have them come in where I have in a period where, you know, their drawdown could be significant because the drawdown of the fund would just be giving back some big profits. And so I try to manage that with encouraging people to invest a bit over time or um, to not invest at this point in time. And yeah, that's, you know, because you're trying to do the right thing and trying to put people in a situation where they're going to make money and I'm going to make money. They're investing right alongside me. And, but, I would feel the same thing. I can't go to my clients and say, blah, 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 close trade equity. No, that's crazy. They're like, what are you talking about? Every day I get my statement, I'm losing money. I had this one client one time and he complained about our performance. Well, we had good performance, but he was saying that we kept misstating the performance. You're misstating your performance. And every day he had to get an email about our daily performance. This guy, he's a professional too. He's a great, smartest guy, one of the smartest guys I know. But every day he wanted to see how our performance was. And so we would send him an email and he would say, every day, every month, you're telling clients that you're up 5%, but it was actually 5.3%. And I'm like, well, you got to remember the reason I do that, the reason you know that we're up 5.3 is because you're in the share class that doesn't pay any fees because you're a good friend of mine. So those are pleasant conversations.
I guess also that some of the people who like shorter time frame trading systems could also be because they try to manage those drawdowns and not be on the risk of having a huge move against them. Just thinking about why would somebody prefer to have a shorter term system. I mean, in a shorter term system, you can have lots and lots of slippage and whipsaws and have a huge drawdown, but not an unexpected one.
Yeah, I mean, I think everyone should prefer to trade as short term as possible. And it's just a trade off. If I could figure out a way to trade shorter term, to to not get back so much profit, to not have so much drawdown, and maintain my profitability. I mean, of course, that would be the goal for everyone. No one wants to trade longer term. I went from trading fairly short term to longer term only to maintain profitability and consistency. As I've said before, these longer term systems, if you try to optimize parameters for consistency, this is what you're going to get: long term systems. And isn't that just a kick in the ass? I mean, so you're saying that your back test shows that in order to make money almost every single year, you have to have more volatility in the open trade equity. Yeah, I mean, that is no fun. I mean, why does it have to be that way?
I don't remember it exactly, but I remember Neil said that Down Capital has such research that the the more short system there is, the more the low robustness is. As remember, so if we have the more long term we are, the more robust we are. Something like that. I don't remember it exactly, but it sounds very good.
Jerry, you mentioned a lot of times about back testing. So I know I'm not the only one who is new here. I know other than the Ed Sekoda's to calculate exponential averages. And do you have any other methods, or is this the only one? And also, can you use a metaphor, like what's the purpose of back testing? I know it's an amateur question. Thank you.
No, it's a good question. What's the purpose of the back test? Yeah, I think the purpose is to just have some evidence of what has worked in the past and maybe see that could continue to work in the future. I prefer the breakouts to the moving averages, but I think anything like that is pretty much very similar. Breakouts, yeah. Maybe trading both. A few breakouts and a few moving average crossovers would be good. There are other ways to do it as well. I've looked at other ways, and I'm just I don't know. I have a bias towards some of the ways I've done it in the past. Um, but I remember back in the day when I was learning how to trade, like they would come in with research and they would say, okay, system one, has the shorter term parameter, breakout parameters, and then system two has the longer term breakout parameters. And system one, if you look at all of the data, system one has better performance. But if you look at um, the recent data, system two is gaining on it. System two is getting better, and system one is not getting better, let's say, or it's staying the same. So, that's I guess that's an okay way as well to try to look at. I like looking at all the data and coming up with a large sample size, and then can make a guesstimate as to. But I trade multiple systems, and they always go in and out. And system one is the best today. System one will be the worst next year, possibly. So I don't get too excited about that. We're looking. What's dominating our performance is these outliers, and it's random on this outlier trades. Five to 10 trades this year. Which exit was the best? I mean, come on, that's that's a that's probably not something you want to pay that much attention to. And if you look at all the data, all of these systems they all make about the same amount of money.
And Lulu, from a decent sized retail perspective, for me, it's a peace of mind for back testing. And it's been alluded to by all of the pros in the room this morning, actually. And that's that it helps you know where you're wrong. and when you need to be looking at your system for changes because you know how it should perform during each market condition because you're trying to get as much data as you can. So 30 years data, with the proliferation of new markets, that the data size is significantly less than what we would like. But particularly when you're experiencing a drawdown, or as we've recently experienced, where you're giving back some profit because I don't have the ability to trade 100 markets. I can trade 30, but I'm I look at it as peace of mind, and I spend a lot of time trying to bone up on my Excel and my Python because uh, you know being able to use those platforms will help you significantly in processing that data.
And to have as much data as possible, of course, certainly so. But there is another thing for me personally that I must understand how it works. So I must be confident in my system, and I'm confident about trend following because it took years for this to believe your system, to love your system, the strategy, and because there is such thing that there is unknown future, such thing that unknown is an unknown future, and we don't know what the future will bring us, as Neil said, Jerry says that the past must be not very good guide. So I think that anyway we must understand how what's the logic behind the system, how it works. So transform is behavioral system, and as I always say that I think that there are some laws of nature that make possible to transform to work. And it works, and it worked in the past, it works now, and will work in the future, I'm sure, because of general laws of nature. And I said it before a lot of times, but I see in every chart, I think see the same, not only in currencies, commodities, bonds. No, I see every chart, and weather chart looks like commodities chart, or like currencies chart, like maybe Japan yen chart if we look at weather chart. And it gives me more confidence in my system.
Man, as you know, I look at the charts and I look at the long-term trends and I put up, breakout channels and I see the big money, these are all very precise terms, and I see what does it take? What sort of exit time frame keeps me in that big trend? And I sit back and I can watch a year or two go by and do nothing and just make all of this money. And so that's the parameter I prefer. And then I plug it into a back test, and the back test says, yeah, that's pretty good. That works. That works. So I'm done, So I'm not going to bone up on my Excel or my back testing. I mean, I don't want to discount it, what I'm saying, but I'm putting the cart before the horse for sure. Here's what I want to trade. Here's what I like. Here's where the big money is made. I'm going to hold on to a position forever until it turns around, and some of them are going to last a year or two, and the vol is going to get really high and the drawdown is going to be big. And these are the parameters. What happens? Oh, well, it works and it makes the most amount of money. Okay, I'm sold. I'll take it. I'm moving on. And so ever since I started doing that, I was more successful than um, some of these research meetings I would come out of. It would be like a religious experience. Oh my gosh, I can't believe we've uncovered this. This is amazing. And then, of course, it never really panned out that way.
So you're saying don't overthink it, Jerry.
Yeah, don't overthink it. I mean, I was talking to Mike this week about where is your research going to be done? Where is the big payoff in the research? I mean, is it really going to be in these parameter setting, or taking, how do I increase my win percentage? Because people despise um, taking losses. And how do we, let's don't buy the breakout. Let's wait for a pullback. I mean, how crazy is that thinking? The losses, and the mistakes, the wrong trades. They're not mistakes necessarily, but they look like mistakes to people who don't trade with systems. We've got those taken care of. I mean, those are like nothing. They're taken care of. 60% of the trades are losses. They're like, I got that nailed. Don't get out too quickly. I have an optimal stop placement and I take a loss. Um, but it's really, during a period like this, you start to say, like, which set of parameters would have gotten me into a big trend. The ones Mike mentioned, like emissions, every single one of them. Yeah, every single one of my parameters would have gotten me in. Well, which one would keep me long? Well, like every single one of them again, maybe. I mean, try not to be too short term or have too many short term exits that would have bounced you out of emissions so far. Uh, so you're saying that it's emissions. Yes, it's emissions, dude. Find emissions. Find some of these other markets that you can put into your portfolio and trade them all, and wait for the market to do its thing and don't screw it up. That's the hero, not you, not me. What parameter is going to allow me to stay into the big trend, milk it for all it's worth, and not give back too much of the profit? But even if it gives back a bit more than some of the other parameters, it may make more money than the other parameters overall as well.
With these losses, with the failures, there's psychological reasons, especially for people who don't understand business, don't understand trading processes, who are new in this, and they think that it looks like failures or something like that, but in fact it's the price we pay as the part of say it every time, that it's part of a successful process, our drawdowns, and we must all understand it very good. And when clients ask me why, clients said that why, for example, clients said I put $100,000 in your account, and now there are $100,000, and now there are only 19,000 of hundreds of dollars. Why it is not bigger? Why my account is lower? Not much as I put the money, and I say that, okay, let's imagine we have a grocery store, and in fact you invested in a grocery store. We bought products and to sell it for a higher price, and you ask me, it's an example, and you ask me as an investor of a grocery store why there is no money and why there is only products. Where is my money? Why instead of this we can see products? It's maybe such an analogy, maybe not the best analogy, but I see it so. So it's a part of the process to buy something and to sell something in a business, and so I think it's a general rule.
Is there a difference between trend following and the system trading, or is trend following the part of system trading?
System trading is strictly rules based. It's mechanical. It relies on rules to make decisions. You can easily create any strategy you'd like with rules. A subset of that would be a trend following system.
And I know Tom Basso has, in a couple of his talks, discussed the necessity for keeping it as simple as possible. And I'm bringing Tom's talk up because it reinforces what's said here and on the top traders uh, just consistently. And he talks about early on in his career how one of his partners had such a convoluted, complicated, rules-based system that this is pre AI and automated trading, but he was away and his partner missed the signal because of all of the if this then that type rules. So it's important that things be as simple as possible, especially if you're not automating it. And I look at it as I can automate all of uh, my trade systems. So I think that's a good indicator as to how simple and how true it could be systematically.
That seems to be a natural progression of traders in general, but maybe more specifically systematic traders, in that they generally start simple because they just want to get going. You know, pre devising up a system, they read and talk just like we're doing here, and come up with some basic simple ABCs type of a strategy day one, and then they start getting into the markets, and feelings come up, things they don't like, things that frustrate them, whatever, and then they figure out ways, start thinking about ways to get rid of them, get rid of that frustration. Yeah, oh man, if only we could just not give back so much money on these big moves. What could we do? um and we for years talking and discussing these types of things in the trading tribe. um it seems to just be a natural progression where you start simple, feelings come up, you get complicated, you make mistakes, you go simple again. You learn the error of your ways, and back to the original question of what's the point, why back test. It's to figure out, like, kind of see what generally works. Like, and how do rules and how do different yeah how do the rules cooperate with themselves, and how do they influence performance? If you change this, what happens? You change that, what happens? So you just kind of get an idea of how things work. So when you get onto the battlefield, you are not playing the guessing game. You know exactly what to do and why you're doing that. Because just like any athlete, you need to practice, practice, practice. So when you get on the field, it's second nature. It's all reacting. It's very easy for you uh, to do the thing you need to do in order to win. You can't just muster it up with some halftime speech or some prayer session before, like, oh man, I know we slacked off this week, but you know if we could just concentrate a little bit, like, it's too late, it's over. You've already lost. So all that back testing, all that research is all for that game time. uh yeah just to be able to be ready on game day.
Are you talking about fantasy sports? Because I don't really see you as much of an athlete in real life, but
Excuse me.
uh,
Let's not have this conversation go south.
I was watching some stand-up comedy of Anthony Jeselnik today, and he's really funny, and he reminded me of you a bit. Uh, yeah,
He's very dark,
yeah,
very dry, very dark.
yeah, yep. In the simple, don't forget though, because I'm Johnny One Note. I don't know if these cliches. Uh, I was born I was born a long time ago, so I don't know if there's still things people know use, but don't forget, that this simple its origination is for robustness. It's not for me. Oh, I'm getting distracted or whatever. No, it's because I have more trades in my sample, and so I'm not against an entry filter. You want to. I'm okay with an entry filter. There was some turtle rules for entry filters that you can systematize that don't reduce the number of trades too much. And of course, the one of the commandments, 10 commandments at least, of trend following is you can't ever miss a big trend. So your filter has kind of a limited value. You have to sort of abandon the filter at some point. So because the market, it looks like it's going to keep going. But I think another thing that happens is you get religion and you do go back to more simple after you've kind of figured out that you can't, it's really difficult to get rid of this volatility and drawdown and still make money. And so the things you add to the system that scratch that itch of what you'd already seen in life, I don't want to see that again. So I'll add this rule. Well, the next time it happens, that rule didn't really prevent the slippage and the drawdown and the vol. And I've definitely run into situations where I basically got rid of the volatility and the drawdown and the profits as well. And then I had to like blow everything up and start over.
Did you ever try some kind of short system with a longer term filter, like the moving up the MACD stuff or something like that?
Oh, can you say that last part again?
Yeah, there are some shorter parameter systems that have a filter like a moving average, convergent, divergent stuff, like a crossover that will kind of authorize the trade, because if it is in a long term uptrend or downtrend, and then you apply the breakout with a shorter term breakout, like the original, for example, Donkian system.
Right. Yeah. That sounds interesting. One of the things that I'm not interested in too much is entries. I'm not that interested in my entries. I'm really interested in them in the sense that I did a lot of back testing and wanted to make them really great. And I think that they are great. but what really gets me though is these drawdowns from these big profits, and and so I'm like, okay, what I've already said that, well, if it really bothers me, I'm just going to get out. I'm just going to take some off with a discretionary move, a bit, not too much, because the back test says that doesn't work. But it would be great to have something like a shorter term system, maybe that went short, or got out and then went short, pretty quickly. And so that would offset the longs I still have with the longer term systems. I like that idea quite a bit. Except those short-term systems, for them to be material, to have a material impact on those givebacks, they have to be shorter term, and those don't work very well. And then you're also in a bind because, oh yeah, this is another kind of bummer in that the ATR, when these short-term signals would signal to get out and go short against this massive long-term trend, the ATR would be really large. And so you could have a unit short of the short-term system and a unit, you're still long a unit of the long-term system. And so you could say, well, they kind of cancel out, but they do from a unit point of view, because the original system was put on with a really small ATR. The recent short-term short, now that's with a large ATR. And so, you're long 20 and short 5, but you're long a unit and short a unit. And so that kind of, I just haven't been able to figure out a way, and especially if your bottom line is making the most amount of money per uh, amount that you're going to risk on a losing trade. So the computer's just going to keep telling you long term and just live with the drawdowns.
I think Mark Rupnitsky summed it up really well in your big podcast when he said that trend following, any kind of system along the lines what we use are long-term volatility, but unfortunately short-term volatility. So as you concluded, Jerry, it's a massive task to offset this short-dated gamma. And my experience has been that applying a long-term trend follower on a short-term scale just doesn't work because the market works differently. And you highlighted the problem with ATRs, which is one, but the other problem is also that short-term systems have to be convergent in nature, and long-term trend following is inherently divergent and positively skewed. So they are difficult to reconcile for many different reasons.
Is ATR the same as exponential averages?
Oh, ATR is just a measurement of recent, or however recent you want the sample size of the volatility. So it's a Google ATR, and it just tells you it's just a way to measure volatility to some degree. There's probably more sophisticated ways of doing it. I don't know if they're any better, but I've used it my entire career. It's pretty integral to what I do. Well, I think that ATR is good. For me, it just has a very limited use, which is to size the position at entry. I think it has issues if you use it more than that. And I look at my risk in terms of ATR at entry, ATR current, and then I don't do anything with it. I just look at it. I'm like, oh, I have a lot of risk on. What are you going to do? I'm not going to do anything. I have a little bit of risk on. What are you going to do? Nothing. I'm not going to do anything. So I look at a lot of things, but once again, I'm choosing my leverage. I'm choosing my size, my maximum positions, all of that stuff. I'm choosing those levels based upon how much risk can I accept on a daily basis, come hell or high water, that will allow me to continue to follow my system. And then I'm going to inevitably probably get uncomfortable with that amount of risk at some point and say, ooh, I have on too much risk. I'm losing too much money. I don't give a crap. Now I don't even care about closed equity or open equity. And so then I'm going to trade smaller. I'm going to have this universal rule that I'll apply that says, okay, get out of 10% of your positions or 20% of your positions, and then start trading 10 or 20% smaller than you were, and now go back to following your system. And that's what that sort of big money management rule, cutback rule gives you. You can go back to following your system, but you should hopefully not have to implement that very often, because you want to not implement that often, so you can keep following your system and trading that size. Because inevitably, when I've done the cutback, I cut back at the lows. The drawdown was over and I started making money, but I was trading 10 or 20% smaller. But that's, I think, okay, given that, another one of your big goals is to stay alive.
Hi there. If it's okay, I had a question about, first off, thank you for turning me on to the Clubhouse itself. It's good to be here. But I've been getting into trend following for about a year now. And one of the things that's thus far been pretty challenging for me, and you guys have been talking about it a bit around the edges so far today, is just screening for markets. I suppose when I first got in, I was suffering from what you might describe as just decision fatigue. There's so many different possible markets that you could get into. And for somebody who's just getting into it, it can be a bit overwhelming. So I wanted to know if you had any advice for how sort of a newer investor could try to optimize, the markets that they do decide to get in with the sort of limited amount of capital they're starting with.
Well, I would no, I think I'll just speak from the point of view of more of a. Everyone knows what I'm going to say, so from a more traditional point of view, the way that I do it and the way I've always done it, and I would just start, with the idea that you want to have a fixed portfolio. So you need to have sort of a fixed group of markets that you're going to trade, so you can consistently apply those rules to the same set of markets. And so I think it's pretty typical that people they can trade stocks, and they don't have a lot of capital, and so I think you can go in there and get some commodity ETFs, some soybean and corn ETF, coffee ETF, natural gas ETF, crude, silver, and gold ETFs. Okay, pick some of those and then pick a few currencies. And I know firsthand this stuff works because my relatives do it and I help them set it up on their Fidelity account. Then, a bond, 3 or 4 bonds maybe, ETFs. I trade some bond ETFs. And then, of course, equities. You got Apple, Microsoft, a uranium ETF, lithium ETF, all kinds of companies out there that are maybe some commodity based or interesting, different, diversified. So you got this diversified portfolio, and you have limited capital. You may have to trade fractional shares, I think, is a thing. And so that's your goal is to, and then, obviously I would advocate trading shorts as well, in those same markets. So maybe that's too much, but that's I would try to mimic what a large CTA can do, and you can go a long ways with getting some diversification and in a regular stock account, I think. And then my stock accounts, IB, for instance, they offer leverage. So if you want a bit of leverage, because in order to trade the bond ETFs, you may have to, size them a bit larger than Apple, and you may have to utilize the leverage component in a brokerage firm to even get any sort of performance out of some of these ETFs in markets that don't have much volatility.
All right, that makes sense. Thank you.
I think it's a good idea to have currencies, bonds, and stocks, different stocks. Commodities prices are high, and of course it depends on how much money you have on your accounts, how much commodities you can trade, and then it can be a problem, I think. But I think it's some mini contracts in some different brokerage firms, but I think that, and I want to add about bonds, that bonds are very, very high correlated asset. And I trade only one euro bond, and it is 25% of my portfolio. All bonds part is only one bond. And I don't see the reason. If I would have more money, it will be another situation, but in my situation I do it. So, and also I trade silver, I don't trade gold, because also the same reason, very high correlation with gold, but silver is much cheaper in the firm where I trade. And so I think so different stocks, one bond, and silver currencies, and commodities as much as you can, as much as you can. And I think it's better here to choose. Of course, if we have a very big accounts, maybe it's not very good idea for picking something. But if account is not much enough, I think it's we must try to choose as much uncorrelated return stream as we can, and commodities. Very good stuff here in commodities. So, and I think it's not very maybe good advice, maybe, but my personal opinion that to pick commodity which is performing well in a previous few years, because there are some such commodities that are performing not good for maybe 10 to 15 years, and maybe tomorrow, maybe in 1 week, it will be very good performance. But if we have free space for only 2, 3, or 5 commodities, I think it's a better idea to choose commodities that have good, like orange juice, for example, that have good, we can see trending charts in these commodities. So here's my opinion. And of course, if we have enough money, we must take diversification as much as possible.
Yeah, and you can look at and there you have diversification issues, but you can look at the micros and uh, minis. Like I said, you'll be kind of limited to the grains outright. You won't be able to do any of the bean oil or the crush or anything like that. But you've got options, and I would recommend, if you're new, looking at maybe applying that to the micros and e-minis, just to kind of get a feel for how it's all going if you're looking at adding the commodities and the currencies.
Hey,
Yeah, thank you for that, and everybody have a happy New Year.
guys, I appreciate being a part of this group. And Jerry is right. I've been doing trend following for about a year and using not many futures, mostly ETFs, and it does work. And you can't short all the ETFs, but a lot of them you can. And then if you can't find an ETF, Jerry has said correctly to find a stock that may represent the uranium market or something like that. So it can be done. I'm new and learning so much and appreciative. I did have a question about when you have multiple systems. How do you keep from being uh, overly correlated? Like if each system is trading corn, are you not overly correlated, or is that where scaling in comes in? I didn't know if y'all could expound on that a bit.
Right. It's just about scaling and diversification of entries and exits. And so my corn allocation in my portfolio assumes that I'll be, long in all systems most of the time, or short. So it's what position do I want in corn if I'm in every single system of corn? That's how I'm going to do it. I'm not going to trade more corn because the systems offer the diversification. I just want that diversification in terms of especially the exits. When you have a big sell-off and a big trade, and the market's selling off, you get out quick, and then you get out system two, but then it rallies and goes back to the highs, so you have at least system 3 and 4 still, or it all crashes, and at least you got out of system 1 quicker than system 4. So it's just that level of diversification in the P&L of the trade, and risk. I suppose that once you get into system 1, it doesn't mean the rest of them are going to uh, get in as well. So you kind of limit your commitment. But then when you do get in 2, 3, and 4, you got in at higher prices. So look, they all make the same amount of money, and you get a bit of diversification. But I think in one of Neil's questions, that I don't know if we got to this question in the podcast, but one was, would you prefer trading 100 markets with um, one system and 4 different parameters? Well, that's what I do basically. I'm fine with this. And what he meant by one system, I think, is a trend following system. Yeah, so that's all I'm interested in, is the trend following systems, and I'm trade 100 markets or 200 markets if possible, and then 4 different parameters on those on that one trend following idea. That's fine with me. That's what I do. And is another part of the question was, or do you prefer 50 markets with 5 different strategies, one being trend following and one being, four others being something else, I guess. So that was easy for me to take the 100 markets. And yeah, and so my systems, they're all trend following, they're all pretty correlated. But on the P&L side, when it finally gets out of a big trade, the P&L for each system can be vastly different.
And I want to say that, of course, first of all, for me, is a diversification between asset classes, and so I think it's the most benefits from business diversification we can see in the diversification across asset classes. And of course, if we have enough money, it's very good to diversificate across systems, across time frames, different exits points, entry points. Yes, it's wonderful. But first of all, I think about asset class diversification, and also I want to talk about um, stocks, which represent different commodities. I thought about this a lot, and I want to say that this idea is definitely good, certainly good, but I think, if you not have enough money, it's a very good idea to buy stocks, for example, uranium or orange juice factories, and it's a maybe good alternative. But stocks are financials. All stocks are financials, and I strongly believe that all stocks are highly correlated. And if we see a massive crisis, first of all, all stocks will go to zero, and we have seen this in crisis 2020 and all crisis. We see maybe the similar pictures. I'm not the best expert in this, but I believe it is so. And if we see commodities, we see another situation. So I think that, and Neil said a lot that commodities are the best instruments in different crises. And central banks, Neil said that central banks has had no influence on the commodities prices. And I think so. If you have not enough money, it's okay to do so, to find different stocks from that represent commodities. But if you have enough money, you must trade commodities, and it's the best way to do so.
Wanted to take a minute, like James earlier. I'm actually new to the group, but to thank you for everyone showing up, and Jerry particularly, and while you were upstairs learning all these rules at the board so many years ago, I was downstairs trying to survive $31.25 at a time. But I wanted to just thank you all again, and I appreciate learning all this because I am maybe it's strange to say I am risk adverse, and so these kind of rules and this kind of process is just perfect for me. I am sick of the 50% drawdowns on some of my accounts and waiting that out. But I did want to just ask quickly, like I think it was James or Jerry with the green hat had just mentioned this kind of new look. Is there a way for me off the shelf? How am I supposed to back test these ideas? I'm not a relative of yours, Jerry, so I can not sure how to get some of these. I can get these accounts going at Fidelity, sure, but isn't there a way for me to back test off the shelf some of these ideas?
Yeah, I think that's difficult to, but once again, like I said, I look at the charts and I just sort of look at the big trends over the years in all the different markets, currencies, commodities, stocks, bonds, and I just try to look at some breakout parameters that will keep me in the trade, but not get me out too quickly, in the midst of on the way to a big trade, but there is going to be some drawdown and volatility until it's pretty self-evident in the chart that, well, that was the top. And so that's kind of how I do it. I think something that's a holding period of 6 months to a year is where you want to be. So without telling you exactly how to do it, just trying to give you some hints of what it may look like. Um, Parameters that keep you in a trade that goes your way for 6 months or a year is what I found to suit me best. Um, oh yeah, so on these I wanted to mention on the ETF commentary that I like to look at those ETFs, the commodity ETFs, well, stock ETFs that are themes, and uranium, lithium, water, timber, and I'll just pull out some of those stocks, and I won't trade the ETF necessarily. I'm like the other Jerry, I'll trade a stock or two from this group that hopefully will give me some correlation to a commodity or something that can be in a shortage or overabundance, let's say. But as I agree with Oleg, look, it's not a commodity. Lumber looks a lot different than a lumber company that owns lumber, and sometimes it looks better, sometimes it looks worse. And I do agree. I think Oleg meant to say sometimes these stocks go to one, not zero. I mean, I guess they can go to zero, but the correlation does go to one. And but sometimes all your longs go to one. Like COVID, it wasn't just stocks that crashed. It was every long I had on that went down. Currencies, commodities, bonds as well. So that's not an excuse, and to say, well, just don't worry about how many stocks you trade. No, I think that you don't want to trade too many equities because the commodities are different, and the commodities themselves are different than stocks that are associated with some of these commodities. It's just always better to trade soybeans than ADM or Cargill, or something similar to that, because that's just a pure play. And but you have to do what you have to do to get diversification in your portfolio, given your facts and your equity. And so you just try to do the best you can. And I spend a lot of time throughout my day trying to find more diversification companies or markets and futures or ETFs. I do trade some of the bond ETFs. And, some of them are kind of correlated, but some of them aren't. The tips, they're setting like all time highs. And the corporate bond ETFs, they're doing pretty well too. But then some of the other bonds, futures and bond ETFs, they're in downtrends.
Yeah, I think that correlation factor is something that we're going to have to deal with just because of the extent of leverage in all the marketplaces, that when there's some sort of systemic ripple that folks got to liquidate, and that means everything's going to go to one. And so it's not, and it gets not to get into the whole crisis alpha debate either. It's just everything's going to go to one because of the amount of leverage.
Well, yeah, I think that that's why it's so important, and helpful to come in to have a broad range of markets that you're trading. So you put yourself in some reasonable possibility to have some shorts on. And we're diversified. We're following the trends. These are givens, and we can't force to have shorts on. But it is nice, like right now, to have a few shorts. I mean, maybe not in the commodities, but a lot of my stocks are short, and some of the indices are short. And then, so I have a fair amount. I have a few shorts in commodities as well. So at least you have an opportunity and to come in with some shorts. So that's about all we can hope for. And if you get caught and by following the trends and it's uncomfortable, then you apply the rule, the cutback rule. Always have something in my back pocket. Well, I think we survived without Richard, and I didn't embarrass myself too much. So we'll look forward to seeing him again and seeing everybody else next week. And have a happy New Year, everyone. And don't forget to go and listen to that podcast. And we'll see you all here next week.
Happy New Year.
Thanks. Happy
Happy
New
New
Year.
Year. Thank you.